Hello and welcome to Internet Capital Markets, the weekly show where we explore how financial systems are being rebuilt on the web. Each week, we sit down with the builders, investors, and institutional leaders shaping this transformation from tokenized assets to decentralized finance, dApps, and everything in between. Today's show is brought to you by TrustBytes, and in this episode, we focus on regulation and innovation. But before that, let me welcome my co-host and co-founder, Jonas, as we are builders ourselves. Hi, Jonas.
Hi, Jeremy, and welcome everyone. I'm super excited for the guest of our today's show. So today we have Peter Kerstens with us. He is a senior advisor at the European Commission. So some would argue from the other side. So usually, or the last shows were all with people from companies, founders, builders. And now we have, like with Peter, someone from the regulatory side, and he is specializing in financial sector digitization, cybersecurity, and especially here, for financial regulation between the EU and US. And he has a long-standing background in EU policy and regulatory processes. So we are really interested to learn how this regulatory environment actually works today. And there he held over the years multiple high-level roles. And Peter, welcome to our show.
Thank you very much. My pleasure to be here.
Yeah, so we actually got introduced through our mutual contact, Mai Santa Maria, and she said, hey, if we want to talk regulation, we need to talk to you. Maybe you can give the audience a little bit more background on your career, on your work at the European Commission, and what led you to basically shape the regulation in Europe, but also with that, like shaping a little bit of the regulation worldwide.
Well, I am a career civil servant at the European Commission. I've been at the European Commission for almost 30 years now. So you could almost say that I'm one of those faceless bureaucrats in Brussels, or I'm part of the furniture of the European Union. And most of that time in the European Commission, I spend in one way or the other related to finance and financial services. I've done other things like food chain security and consumer protection, so very different fields, but most of my time I spend in financial services. And if you look at financial markets and you look at financial services and what is driving markets and where the opportunities lie, and you then also take a bit of an interest in digitalization, technology, and innovation, it doesn't really require the brain of Einstein to figure out that digitalization and financial markets are a match made in heaven, that they go hand in hand, and that while we see digitalization transforming the economy everywhere, it is particularly visible in financial markets. And that is also because the financial sector as a whole is the largest IT sector of our economy. No sector spends as much on ICT as the financial sector. So I have an interest and a background and expertise in the financial sector. I have an interest in digitalization, and bringing these two together, and that started 10 years ago in 2015. I was made advisor for technological innovation, digitalization, and cybersecurity at the European Commission's Financial Services Department. So that's how I got here.
Yeah, I do believe we have a lot of overlaps here. So I mean, we are basically coming from the crypto side, from the blockchain side. We are building in this ecosystem for years now, and obviously now also the regulators got interested in it, because they saw, okay, this might be a technology that can be used in financial services. We need to think about regulation as well. But before we dive into that, what was your personal motivation to actually start to shape regulation in Europe and basically come up with a framework or frameworks rather over the years that really shaped the financial regulation in Europe?
Well, I think that there are two sides to it. On the one hand, I'm a bit of a tech geek. I love technology. I love innovation, even if I half of the time don't really understand it, but I still love it. I like it. I like progress and change. But also, if you specialize in financial services, and you mentioned, for example, tokenization and blockchains and so on. I am, even though I did the marketing crypto assets regulation, I designed it. I, by no stretch of the imagination, an expert in blockchain technology. What I am an expert in is in traditional financial market infrastructure and financial market technology. And I know how it works and also where it doesn't quite work or where it leaves us sort of um, things to be desired. And when I then started looking into digitalization and I started off in cloud computing, but then quite quickly came across blockchain and Bitcoin and crypto assets, I sort of said, well, a lot of people are very focused on the risks and the fraud and all the scams and so on. But I said, there's a tremendous opportunity in this technology for our financial markets to make them more efficient, to make them give them wider reach, to build opportunities. And that really motivated me to start building a policy framework that not only provided some rules of the road, but that mainly enables blockchain innovation, enables distributed ledger technology innovation, that enables tokenization in financial markets, because I believe that that's really where the future lies. I don't want to belabor the point, but I'm absolutely convinced that if there was no financial market infrastructure today, let's say nothing existed, no payment systems existed, no clearing houses existed, no trading venues existed, and people were told, go and build a financial market infrastructure. There is no doubt in my mind that it would be built on distributed ledgers and it would be completely tokenized. Now we have lots of legacy infrastructure that works. In some places it works better than in others, but where it doesn't quite work that well, blockchains offer enormous opportunities to overcome these shortcomings. And that really motivated me to develop this framework that embraces this technology. It doesn't prohibit this technology, it doesn't ban anything, but it tries to shape a framework, set some rules of the road, while at the same time, of course, recognizing that not everyone is as enthusiastic about the technology as I am, and therefore regulators who, of course, are very much focused on risks and things going wrong, wanted to have maybe a bit more safeguards than I would have myself put in. I think that if a car has seat belts and an airbag, that's plenty. But some people also want to have cruise control and speed control and all kinds of other automatic driving. I'm not convinced you need everything for safety purposes, but that's really the democratic process. So not everything that is in our regulatory framework is ideas that came from the European Commission. It's some the Parliament added some things, member states added some things, regulators added some things, but by and large, we really wanted to enable blockchain technology in financial markets.
Yeah, that's super interesting that you also included some elements from other areas. And you actually served as a financial counselor in Washington, D.C. and have worked closely with global policymakers. Can you tell us a little bit about how this international perspective has changed your approach to regulating digital assets and what differences you actually see between the US and the EU?
It's the US, but not only the US. Also, if I look at Asia, for example, and the APAC region, every time I go there, I'm struck with the energy and the drive and the dynamism by those markets. And in Europe, let's face it, we're a bit sleepy when it comes to the energy in our markets. And while we may have the most elaborate and developed policy and regulatory frameworks, we are a bit of a regulatory powerhouse. We by no means have the drive and the energy and the development capacity and the risk capital that is available, and the willingness to take some risks that we see, for example, in the United States, but that we also see in the Middle East and in Asia. And while I'm very bad at predicting the future, if I could predict the future, I would have a different job. I do look at those markets to sort of say, well, what do you think the future will bring? What is going to come to our markets in the not too distant future. And that's where I take inspiration from developments in the US. And for example, my interest in digitalization in finance really was sharpened while I was based in Washington between 2008 and 2013, where especially towards the end of my mandate there, I got struck by the amount of attention that was paid by policymakers and regulators to cybersecurity and the role of technology in finance. And when I reported this to my authorities here in Europe, they sort of said, well, we don't really think that that's a big issue. We want to look at capital requirements and banking rules and all kinds of things. I said, well, look, I think cybersecurity is and cyber resilience is going to become a very big theme, and the dependency on non-financial entities, third-party service providers, and so on is going to be very, very important in future. And initially, there was not a lot of uptake of that. But then in 2015, people sort of said, well, look, yes, we do hear an awful lot about cybersecurity and digitalization. And my boss said, well, Peter, you've been going on about this stuff for a while. You're in charge. And that's what motivated me.
Yeah. In terms of motivation, interesting fact is you're also called the father or the architect of MiCA and DORA, and MiCA is also the world's most comprehensive crypto regulation there is. What was actually the starting point? What problem were you trying to solve when drafting it?
The ideas of what became MiCA later on really emerged with me early 2018. At the back of the first big Bitcoin bubble, if you wish, what people call it a bubble, when Bitcoin was trading at the dizzying heights of $18,000, a little bit more, people said, this is completely crazy. A lot of regulators and conservative analysts sort of said, Bitcoin has zero value. Why are people spending thousands of dollars on some code? This is nonsense. That was one thing. So there was a lot of excitement in the market, and also the ICO wave. And it was mainly the ICO wave that piqued my interest. The fact that it was possible to raise capital in a crowdfunding way, if you wish, by issuing tokens to develop a project, an innovation, was something which I thought was very powerful, because we're always looking at ways to raise capital. It's extremely hard to raise capital for a new venture. And an ICO offered a new way of raising capital for ventures. Now, what we did see in the ICO wave was that many of these people raised more money than they ever expected to make with whatever invention they were, whatever thing they were going to build. And so they moved from being builders and developers into treasury managers overnight, and many never developed anything. The ICO itself turned out to be fraudulent, but the concept of an ICO was very, very powerful. So that's where I set out to sort of say, well, wouldn't it be good if we could embrace this approach and put some rules around it? So what is allowed, what is not allowed, how do you raise money to an ICO, and bring this new way of capital formation to European markets. That was in 2018, and there was no uptake for this idea at the time. People sort of said, this is a waste of time, this crypto stuff is going to disappear, it's going to end in tears, it's all money laundering and fraud and what have you, so you're wasting your time. And then in 2019, we had a bit of a lucky break as a policymaker, as a regulator. And the lucky break I had was that a company, a small company called Facebook, had the audacity to launch a stablecoin, or the concept of a stablecoin, Libra, and it was going to be multi-currency and so on. They were going to power social media with a payment system based on blockchain, based on a token-based system. I thought this was a very powerful idea, but it scared, excuse my French, the living daylights out of quite a lot of regulators, who immediately said, well, this crypto stuff, from being irrelevant, now is becoming too big to ignore. If companies with 2 billion customers are starting to engage in this, we really have to start paying attention. So regulators, policymakers at the highest level, at the G20, then sort of said, we need to put a regulatory framework in place for this. For when this starts getting going, we need to have rules of the road. And that's when I took my ideas from 2018, added some ideas on stable coins, and this is what really became the MiCA regulation. So that's how the ideas get together, both enabling the technology, but also putting some controls, because of course, if you have no controls, these things can easily go out of hand, because there's quite a lot of what I would call grifters around in crypto space who are not looking at the technology for the good it can do for society, who are mainly in this space to make a quick buck at the expense of others. And of course, that is not what we want to see happening.
Yeah, I mean, this Libra thing is like a very interesting point in time in my view. I remember it when it got started without even like understanding it in the first place. Although I was into crypto back then, but it's like very interesting to see like how the regulators got scared by it, right? On the other hand side, like young people often get scared by regulation, or like company builders, startup founders, because they obviously don't want to violate the law. And on the other hand side, they also don't have like a lot of money, especially like in early phases of projects, to spend like huge sums on lawyers, right? So, and I do see like there's a difference a little bit between like people in Europe and people in the US, where people in the US often act like a little bit like move fast and break things and then try to fix it later. While in Europe, many people just try everything to do it right and not violate the law by all means. But what would you recommend like young people or like startup founders and maybe also like protocol builders, where to start when it comes to regulation, when they want to build a company or a protocol in Europe, out of Europe, regulated under MiCA?
Well, I would say, first of all, don't listen to the lawyers too much, and don't spend too much time or money on the lawyers. I know lots of lawyers who are specialized in this field, and the way they present, for example, the MiCA regulation or the DORA regulation shows that they haven't understood nothing of it. So these are not the kind of people you want to spend money on advising you on how to take this forward. We really try to design, especially MiCA, in a way that it's understandable to normal people, that you don't need a lawyer to understand what it actually says. I'm not saying it's great literature. It's puts you to sleep easily because it's a bit boring. But if you are smart enough to code up a protocol, or if you're smart enough to code up a smart contract, if you can do that, I'm sure you can understand what MiCA says, which basically says, look, if you're going to raise money to an ICO, you have to make some disclosures. You have to sort of say who you are, what is your building. You have to give some warnings. If you're going to do a stable coin, look, you need to have an authorization for this. You need to hold reserves. You have to manage these reserves in a particular way because you're dealing with people's money. If you want to become a trading venue or a custodian or an advisor or a broker, there are rules which are very typical for the financial field. They are not rocket science. They really are common sense, because what we tried to do with MiCA was we tried to encode into the legislation the best practices that we saw already developing in the market. How do properly organized and governed companies in this space behave? And early on, I saw a lot of what would I call crypto bros, libertarian guys. I love them, great guys. Half of them were mad crazy. Some of them should probably be in jail. Well, some of them are now. But interesting guys and often girls, or sometimes girls. Great view, great vision. But they really only got going once they started teaming up with people who have some experience in how financial markets operate. Like crypto for crypto's sake doesn't really well with how financial markets operate. But when they started getting into contact with traditional finance people, you saw that useful practices, good practices were being developed about how you organize a trading venue, what things you should do, what things you shouldn't be doing. And essentially, what MiCA says is behave and treat others like you would like to be treated yourself. If I had to summarize MiCA in one sentence, that's what it is. And the other thing is how to avoid spending lots of money on lawyers. If you're building something and you have to ask yourself the question, is this legal? That's probably not a good idea. If you think, well, why would I want to do this? If you doubt yourself whether it's something legal, you're probably coming too close to the line and you probably shouldn't be doing it. What I do see a lot is that people sort of say, well, look, they hire lawyers to find a loophole here or there in the regulation. There are many loopholes in the regulation because it's a bit of committee drafting. It's not always that clear. So you can basically parse your way or navigate your way or gerrymander your way between various articles and get away with things. But people who try to avoid the regulation, in my view, often end up providing products that are not worth having or that do not serve markets well or that do not serve customers well. So trying to avoid the rules is a bit hard. And ultimately, if you really have questions about these regulations, if you read them and say, well, what does it all mean? Send us a letter at the Commission or say, what does this mean? Send me a letter or send me an email. Shoot me an email. Say, what's the purpose of this? What does it mean? And we're not into giving consultancy advice or business advice and so on. We don't get involved into endorsing projects or promoting projects and so on, but we're quite willing to answer questions on the rules if there are questions.
That is, I believe, like very interesting because when I got started, I probably wouldn't have this idea to reach out like to the regulator to ask like questions about the regulations. At least that would not be my first idea. And I do agree that, I mean, now like probably the decentralization maxis are like outraged, but I do believe like also seeing that all the big financial institutions are now coming in to crypto, and that there's like a need on both sides, right? We, on the one hand side, we need these big financial institutions to grow the entire space, and all these also crypto decentralization, maybe even Bitcoin maxis do want to grow. Of course, they want to see growing prices, but they need to sacrifice something, and that is probably like a little bit like giving up of like decentralization or like letting like huge financial institutions coming into the space. So there's like a balance to be made in my view. Talking about that, balancing innovation, consumer protection, and also market integrity is not trivial. So what were the most difficult trade-offs you or the European Union, European Commission in that sense had to make when coming up with MiCA?
I think the most difficult part really was the stablecoin part because a lot of regulators felt that stablecoins were a threat to the banking system, that they would lead to deposits being pulled out of the banking system. And deposits are very important in the banking system because they support lending. If banks don't get deposits in, they don't have money to lend out to grant credit. In the US, it's a bit different because in the US, banks are much more financed in capital markets, but European banks are mainly financed through deposits. And so if they lose part of their deposits, then the banking system may suffer. So there was a lot of fear that combined with the fact that stablecoins at the time were pushed primarily by, let's face it, big tech conglomerates. And that led to a fear among many regulators. Not, I would say, personally, I wasn't that fearful of it, but many of my peers and colleagues were very afraid of that. And that's why the rules in MiCA on stable coins, both electronic money tokens, so those that are linked to a specific currency, or asset reference tokens that are linked to a commodity or a group of currencies, that these rules are tough and quite restrictive. So they're not of a nature to make stablecoin issuance a profitable business. Now, if you are big enough, if you have a lot of volume, then in a high interest rate environment, it's hard to run a profit. But in a low interest rate environment, and bear in mind that when we did MiCA in 2020, 21, we were still in a very low interest rate environment. You have to have a particularly significant size before this would become a viable business. And this was by design, because quite a few of our member states and members of the European Parliament were no fan of the notion of stable coins, and still are not. We still hear a lot of concerns about stable coins in Europe. And sort of I think that stable coins are part of the normal transition of innovation towards a tokenized economy. I think we need them, and it's just a natural stage. But many people are very fearful of them, and that's what most of the negotiations on MiCA, which last for about 2 years, were spent on stablecoins. The rules are tough and strict, but in a way they appeal, because if you look at the US, who recently adopted their stablecoin legislation, the Genius Act, it is pretty much the same as MiCA Title 4, which is the electronic money token part. The lawyers always gasp when I say that Genius and MiCA are the same. I confirm it here, they are the same. Yes, there are small differences in rules and specific provisions, but in the greater scheme of things, this is far, far, far more the same than it is different. And this shows that the balance which was struck in Europe between innovation and protecting the banking system and sort of not going too far seems to be the right balance between those which are stablecoin maximalists or crypto maximalists or decentralization maximalists, and those who sort of say, well, let's cool it down a bit, sort of let's go down, because you see that the rules are being emulated. MiCA is being emulated in the US, but we also see it, for example, in Asia. And now many people on this show may be more crypto inclined, maybe more crypto positive, so they may find these rules all rather restrictive, and I do think they're quite restrictive. But bear in mind that we are, or the crypto community is a bit of an ecosystem, and most of society is not in crypto space or in crypto land yet. They are in a different ecosystem, so they are quite fearful of all of this, because they say, how can you trust a system that's just based on computers and math, and that doesn't have reliable institutions with them? Of course, where does the trust in these institutions come from? Does this trust come from the regulation these institutions are subject to? Does the trust come from the fact that these institutions are all led by well-meaning philanthropists who want only the very best for society? There's reasons why people trust or don't trust certain things. And what I notice is that people do not yet seem to have an awful lot of confidence or trust in code or mathematics, partly also because, like me, they don't understand code and they don't understand mathematics. I believe that I've now reached a sufficient level of basic understanding to understand that you can trust it, and that mathematics is usually more trustworthy than people are. But most people would lie their trust in other people rather than in mathematics and in code, which is a bit irrational, because I think that code and math are more reliable than people.
Yeah, yes. Speaking about that, and our show is actually called Internet Capital Markets. And we believe that the entire financial industry at some point will move eventually on-chain. From your perspective, what are the conditions that must be met for that to happen?
Well, you need an attitude change and sort of trust in the technology, and that's gradually coming. So when we proposed MiCA a bit more than 5 years ago, most self-respecting people in the financial sector did not want to be caught dead near anything to do with the blockchain. They said, this is not for us. We also tried the DLT pilot regime, which was the use of distributed ledger technology and on-chain technology in traditional financial markets. And we had a lot of pushbacks, because people sort of said, well, you know what? No, if we go to this ledger technology, it has to be private and permissioned ledgers and so on. No, of course, we can't go to a permissionless chain. A lot has changed in the last 5 years. And now I see the big brand names of finance, the large financial institutions, all lining up in front of our door wanting to tokenize everything you can imagine. They want to go very fast, so they've changed. So that changed, but a number of things really have to change for markets to go on-chain. And bearing in mind that in many parts of the world, there's no absolute necessity because our system, as we have it in Europe, in the US, works okay. It's not perfect, but it works. It delivers. Other regions of the world, it doesn't deliver, but for us, payment systems, that's what it delivers. So we don't necessarily need to change it, but we could improve it. And for that to happen, a number of conditions need to be fulfilled. And most importantly, I think, is that the buy and the sell side in the market need to want to move to a better system.
Mhm.
Buy side and the sell side are not interested, it's not going to happen. Financial markets will not transform because of retail interests. Retail interest is interesting, but it's kind of a sideshow. It really is the big institutional players that determine how the market evolves. Secondly, is for financial institutions to really engage in this space, they need to have, in particular banks, they need to have realistic capital requirements for crypto exposures. Now, this is very technical. It has to do with Basel standards for capital requirements for crypto exposures. And these are currently set at a very, very high, very conservative level, making it rather uneconomical for banks to be engaged in this space. So if you want to move on chain, that will have to also be addressed. And these standards would have to be adapted to make them really risk-based rather than fear-based, crypto or on-chain fear-based, which in my personal view is what they currently are based on. Thirdly, this is also very technical, is that tokenized assets have to be accepted as collateral. This is very legalistic, but a professional investor, an institutional investor, invests in assets not only because he or she hopes that they'll yield some or expects them to yield some dividends or that they'll increase in value, they also want to use those assets while they have them by posting them as collateral and sort of lending against them and so on. They do all kinds of stuff with it. And for that, the tokenized assets need to be accepted as collateral. And therefore, those entities, central banks for central bank lending, also other institutes, need to accept tokenized assets as collateral. And we're not there yet because in order to accept an asset as collateral, two conditions need to be fulfilled. One is they need to have assurance that the assets are in proper custody so that they are kept safe. And secondly, the assets need to be tradable, that if the collateral needs to be seized and needs to be liquidated, they want to have a market, a liquid secondary market in which to liquidate this tokenized, these tokenized assets, this collateral. And there, for that to happen, you need to first have a tokenized financial market. So it's a bit of a chicken and egg story, but it's a condition that needs to be fulfilled. Fourth condition that needs to be fulfilled is that while in theory you can settle asset for asset, so you could settle, for example, Bitcoin for tokenized NVIDIA shares, in principle that's possible. In practice, you settle in financial markets in cash or cash-like instruments. And while you could use stable coins, the volume of stable coins really is far from sufficient to meet the needs of financial markets. We currently have $280 billion of stable coins in the market. That is not enough to meet the needs of financial markets. You need many, many, many times as much to meet cash on ledger, to meet the needs of financial markets. And no stablecoin issuer, no matter how magnificent or how big, has the elasticity and the size to deliver the amount of tokenized cash that may be necessary to meet the needs of on-chain markets. Only banks, and in particular central banks, have the capacity, in particular the elasticity, to meet the cash demand, to provide the cash when necessary, to withdraw the cash when necessary. So that is another condition for this market at a wholesale level to move on-chain. And also central banks will not want these markets to move on-chain without them settling in central bank money because they would lose control. So these are four essential conditions, I think market-based conditions. And then the fifth condition is that the regulatory framework has to be adapted to it. It has to be permissive for this. It has to enable this transition. And while I am still struggling to find real barriers in the regulation for this transition, there are some things that probably need adaptation, because if you look at our financial regulation the way it currently is, the regulation governing financial market infrastructure, so not MiCA, but traditional financial market infrastructures, those regulations were developed with those traditional financial market infrastructures in mind. They were sort of made to measure for that tech stack. We're now transitioning gradually to a new tech stack, and the regulation is not adapted or is not developed with that tech stack in mind. And so a regulatory adaptation to the new tech stack is probably also going to be necessary for on-chain markets. But we are not yet sure what all changes are that are necessary, because the on-chain environment hasn't reached its end stage. We're only at the beginning. So we're still need to learn as to, well, what changes is really necessary. And for this, we need input from the market, from people who are trying to tokenize things and who are confronted with real regulatory problems. So not some problem invented by a lawyer who's charging them way too much money for the advice they get, but say, well, look, we try to do this, but we can't, because while it is a good idea and there's a lot of interest in it, Article X, Y, or Z of that regulation prohibits it. It really does not work under this. And we are really working at the Commission to make, at the European Commission, to open up to that, so to hear from the industry what really doesn't work in this new environment and how can we fix it.
Thank you for walking us through the 4 key conditions that we have to meet. And while we are at the beginning of the regulations and things to happen to actually bring all the institutions on chain, we are at the end of our show and come to our last part, which is quickfire. So let's change gears a little bit, and I will ask you 1 question each, and you have 1 word to answer. So are you ready?
I'll try my best.
Okay. 1 word to describe MiCA in practice.
Enabling.
The most underestimated part of DORA.
The first part, governance, ICT governance.
The biggest risk in digital finance today.
Lack of understanding of technology.
Permissionless or permissioned?
Permissionless any day.
1 regulation you wish existed 10 years ago.
Our future DLT enabling market infrastructure regulation. It doesn't exist yet today. It will exist in the future, and I wish it existed already 10 years ago, at least 5 years ago.
1 thing Europe gets right about crypto.
One thing one
thing that Europe gets right about crypto.
It's an opportunity. It's about opportunity.
And 1 thing Europe needs to fix fast.
Europe needs to be willing to take risks. It needs to be ready to innovate. Innovation comes with risk. Not everything, it's more than 1 sentence, not everything you try is going to work. But if you're too afraid that it may fail, you're never going to try anything. So Europe needs to be more fearless.
If you could regulate 1 emerging technology tomorrow, which one and why?
I wouldn't regulate any technology. I think technology is just technology, should not be regulated. Only behaviors and entities should be regulated.
Okay. And the last question, you have 1 sentence to answer. What advice do you give fintech or crypto founders navigating the evolving EU regulatory landscape?
Well, I'll repeat what I said before, is do what you think is right. Don't listen to the lawyers.
I love that. I really love that. Don't listen to the lawyers a lot, or like too much. Let's put it this way. Peter, thank you so much for your time. And before we wrap it up, where can people find you, can learn more about you, and where can they reach out to you? So to ask you questions about regulation. So if you really mean it, please tell them where they can find you. And last question before we really wrap it up, who should we talk to next?
Who should you talk to next? I'll tell you. He's an Irish fellow, Michael Carr, who is, in my view, one of the consultants in this space who has understood both DORA and MiCA the best. I've never come across anyone across Europe who understands the essence of this regulation as well as he does. So I encourage you. I don't know whether you know him. He runs a company called When Crypto. He's someone interesting to speak to on how this regulation, which we developed in Europe, how this is being applied in practice on the ground. So that's interesting. And so the other question was, I forgot the other question.
Where can people find you?
Where can people find me? Well, on LinkedIn, I spend a lot of time on LinkedIn, and I comment sometimes on crypto-related matters and regulation-related matters. So just look me up on LinkedIn, connect. Well, I say who you are, why you want to connect, because otherwise I have to ignore it. So that's one way. Or they can send me an email at my email address, which is peter.kerstens@ec.europa.eu. I'm not interested in buying your product. I'm not going to endorse your product. I'm not going to invest in any of your ventures because that's not my job. But if you have questions about our policy, our regulation, what was intended, by all means.
Perfect.
Oh, thank you so much, Peter. This was really insightful. And we could talk for ages, but maybe there will be another episode. And this wraps up this week's episode of Internet Capital Markets. A huge thank you to the listeners, but also to Peter for joining us and sharing the insights and what it actually means for the different parties playing in the field of Internet Capital Markets. If you enjoyed today's discussion, make sure to subscribe, rate, and share the show. It helps us to bring more conversations with the people shaping the future of on-chain finance. This is Internet Capital Markets. Join us next week as we continue exploring how tech, capital, and human creativity converge to build the future of the systems of tomorrow. Until then, stay curious, stay connected, and keep building the future of finance. Goodbye.